Hi, my name is Hilda Taylor. In this presentation, I will discuss financial ratios. American Bacon Incorporated includes the balance sheet and income statements for the year of 2010. Financial ratios can help make sense of the overwhelming amount of information that can be found in a company's financial statements. Knowing how to pick out small bits of information, important information, combine them with other small bits of information, and interpret the resulting number is more than a science, but one of the most important arts that a business should practice. The five additional info I have chosen are return on assets, current ratio, quick ratio, debt of equity ratio, and interest coverage ratio. The return on assets, or ROA, we will utilize the income statement and the balance sheet. The formula for the ROA is as follows. ROA equals net income divided by total average assets. This means that a company buys assets such as factories and equipment and other assets in order to conduct its business. ROA tells you how good the company is at using its assets to make money. The higher the ROA, the better for the company. Current ratio utilizes the balance sheet. The formula for this particular ratio is current ratio equals current assets divided by current liabilities. It measures the company's ability to pay its short-term assets. If the ratio is over 1.0, the firm has more short-term assets than short-term debts. But if the current ratio is less than 1.0, the opposite is true, and the company could be vulnerable to unexpected bumps in the economy or in the business climate. Quick ratio utilizes the balance sheets. And the formula for this is quick ratio equals the current asset minus inventory divided by current liabilities. So what does this mean? The quick ratio is also known as the acid test ratio, which is similar to the quick ratio in that it is a measure of how well a company can meet its short-term financial liabilities. However, it takes the concept one step further. The quick ratio backs out inventory because it assumes that selling inventory would take several weeks or even months. The quick ratio only takes in account those assets that could be used to pay short-term debts. Number 4, debt to equity ratio. So what do you need for this one? You utilize the balance sheet. The formula for this is debt to equity ratio equals total liabilities divided by total shareholder equity. So now what does this mean? Total liabilities and total shareholders equity are both found on the balance sheet. The debt to equity ratio measures the relationship between the amount of capital that has been borrowed, i.e., debt, and the amount of capital contributed by shareholders. This is your equity. Generally speaking, a firm debt to equity ratio increases. It becomes more risky though because if it becomes unable to meet its debt obligations, it will be forced into bankruptcy. So God forbid that we should go into bankruptcy. Last but certainly not least, we will utilize the interest coverage ratio. So what do you use for this? We utilize the income statement. The formula for this particular ratio, we interest coverage ratio equals EBIT divided by interest expenses. So what does this mean? Both EBIT, which is also known as operating income, and interest expense are found on the income statement. The interest coverage ratio, also known as time interest earned, is a measure of how well a company can meet its interest payment obligations. If a company can't make enough to make interest payments, it will be forced into bankruptcy. Again, anything lower than 1.0 is usually a sign of trouble. So managers and business owners, please beware. Thank you.